I've done it.
Okay, thanks. I hope you can hear me then, and student can hear me. Good afternoon, students. Today I'm just going to be very brief. I think I highlighted earlier the purpose of today's session. We need to address just remember that today we have released compulsory assessment number 2, and on that compulsory assessment number 2 we are covering learning unit 6 up to 10. So the session that we are covering today is also to assist you in completing compulsory assessment number 2. So let me just go straight. So the purpose of today's lecture, we need to understand why do we perform closing procedures and when do we perform those closing off procedures and how do we perform them. So it's very important to have an understanding of this so that you will see when we assess you or on closing off procedures how they are actually done. So the reason we perform closing off procedures firstly is to determine the financial result of an entity and also to prepare financial statement. So for us to know how much profit has been made by that particular entity, we need to do the closing off procedures. I will explain the process below how it's actually done. So, and before you can prepare financial statement, you need to close off your nominal accounts. So when you talk about nominal account, we talk about temporary accounts. Those accounts, they only exist for that particular period. So when you talk about nominal account, we are talking about your income and expenses account. Remember that we said on our previous session was that we said income and expenses, they only exist for that specific financial period for only that 12 months. That's why we did on learning unit 6, the adjustment where we said all the income or expenses that do not form part of the current financial period were taken out. For example, we had prepaid expenses, we had income received in advance, we removed those ones. So because they did not form part of that particular financial period. So when we do this closing off procedures, closing off these nominal accounts, which means we are closing off your income and expenses account. What we are actually saying in simple terms, we are saying zero out those income and expenses account for that particular period. So for example, in our basic accounting equation, we know that income increases on the credit side and it reduces on the debit side. For if we want to zero out that income account, so it means we need to debit that income account and then we're going to credit that relevant account that we're going to discuss now. Then if you want to close off, you want to zero out the expenses account. We know that expenses increases on the debit side, they reduce on the credit side. So to zero out the expense account, it means we need to credit that expense account and then we debit the account where we're going to close it off to. So when we do the closing off of the nominal accounts, we transfer those nominal accounts to what? To the trading account, to profit or loss account, and to capital account. I'll explain on the next slide as we proceed which account will be closed off to your trading account and which one will be closed off to your profit or loss account and which one will be closed off to your capital account. So already, I think we've already covered this in terms of why do we perform them. If the intention is to prepare financial statement at year end, closing off nominal account will also need to be prepared at that particular time. So remember that when you are preparing the closing off nominal accounts, you do this after doing what? Your year-end adjustments. You cannot close off the accounts without doing your year-end adjustment. So it's important that you prepare first your year-end adjustment and then you can perform your closing off nominal accounts. Remember that without you considering year-end adjustments, the balances that we'll have in those accounts will be incorrect. So whatever that you are closing off incorrect accounts. So this is the order of closing off the nominal accounts. I will say again, nominal account, we are talking about temporary account. Temporary account we are referring to our income and expenses account, because those income and expenses account, they only exist for that particular financial period of 12 months. So these are the ones that need to be zeroed out at the end of the year. So this is the order that we do our closing off procedures. Number one, you take your net sales and your cost of sales, you close them off to what? To your trading account. Here in the trading account, what are we trying to determine here? We are trying to determine your gross profit or loss, whether did we make any gross profit or loss. That's why we are saying only net sales and cost of sales are closed off to your trading account. Once you have done that, you move to step number two. Step number two, this trading account, then what is going to happen is that that trading account is also a temporary account. It also needs to be closed off. So this trading account will also need to be closed off to your profit or loss account. So it's very important that once you have closed off your sales and cost of sales to a trading account, that trading account also need to be closed off to your profit or loss account. Then number three, you will say all other remaining income and expenses will need then to be closed off to your profit or loss account. Two things that we have already highlighted here is that on trading account, it only net sales and cost of sales that's going to be closed off there. Then all the remaining, like all the other remaining income and expenses we're talking about here, rent income, commission income, stationery expense, purchases expense, water and electricity expense, rental income or rental expense will need to be closed off to where? To your profit or loss account. Once you have closed off that profit or loss account, that profit or loss account is also a temporary account. It needs then to be transferred to where? To your capital account. It needs to be closed off to your capital account. That is step number 4. And the last one, what you also need to do, the drawings need to be closed off to your what? To your capital account. It is very important to understand this order, as simple as it is, so that you don't get lost when we ask you to do closing of journal entries. So you know exactly how to write those closing journal entries. So we'll do the examples as we proceed, but I want you to remember that when we are doing the closing of nominal accounts, we are closing off all our income and expenses, because those are your temporary accounts. Those are your nominal accounts that need to be zeroed out at the end of the financial year so that we can prepare our financial statements. So just on step number 1 that we've spoken about already, we said net sales and cost of sales to be closed off to a trading account. The reason I'm saying net sales here, remember that on your, let's say on your trial balance, you will have sales, you'll also have sales returns, you'll also have settlement discount granted. What you are closing off to this trading account, it after deducting your sales return and your settlement discount granted. So which means your sales return and your settlement discount granted, it will need to be closed off first to your sales. Then your net sales then will be closed off to your trading account. So in the trading account, we've already highlighted, we are trying to determine what? The gross profit or a loss. So how to calculate gross profit or loss? You will just say your net sales less cost of sales. And net sales, I've already explained, is that you say sales less sales return less your settlement discount granted. So here I was just highlighting that before you can close off your net sales to a trading account, ensure that the sales return and settlement discount have been closed off to the sales account. So remember that your sales return and settlement discount granted will reduce your sales. So which means when you are closing off the sales returns and settlement discount granted, your sales need to be what? Need to be debited, and you credit your sales returns and your sales discount granted. So that's why we have minus here, so that it leads to a reduction. Remember, sales, it's an income account, it's increased on the credit, but to reduce it, you debit that. Then with Then in terms of, remember that here to determine your gross profit, you also talk about the cost of sales. So cost of sales, here I'm just highlighting that the determination of cost of sales sometimes it depends on the inventory system that is used by the entity. Remember that we have two inventory systems that we are using. It's perpetual or continuous inventory system or periodic inventory system. We'll explain on the next slide in terms of this system, because it's very important for you to understand this system, because it affects the transaction that you're going to write when you are dealing with each of these inventory system. Let's start with the first one, perpetual inventory system. Under perpetual inventory system, when we purchase inventory, that inventory that has been purchased, it is recorded directly into the inventory account at a cost price. Remember, a business, when they go out and buy inventory, remember, inventory is an asset for the business. When you go out and buy that inventory and then the inventory get delivered, that inventory is increasing. So which means it's an asset, it increases on which side? On the debit side. So you'll have to debit that inventory and then you credit. If you bought it for cash, you're gonna credit what your bank. Remember, bank is an asset, and asset reduces on which side? On the credit side. But remember that you are recording that inventory directly into the inventory account at a cost price. Then under perpetual inventory system, when you make a sale, when you sell that inventory, what you need to do, the cost price of the goods that have been sold, you transfer it from inventory account to your cost of sales. So what we are saying here, when you make a sale, firstly, you're going to record a transaction that recognizes the sale that it took place. And number two, we need to update our inventory records by doing what? By transferring the cost price of the goods that have been sold to what? To your cost of sales account, which means the goods that have been sold are that inventory that has been sold, it's reducing now. So inventory is an asset, it reduces on which side? On the credit side. So you're going to credit your inventory, and what are you going to debit? You're going to debit your cost of sales. Remember, cost of sales, it is your expense. And then your expenses increase on which side? On the debit side. But you will see when we take you through the examples as we move forward. Number two here, I just wanted to highlight here our basic accounting equation. Never lose sight of basic accounting equation. All the time when you think about the accounting transaction, think about how does it affect your basic accounting equation. We know asset and expenses increases on the debit side, they decrease on the credit side. Then equity, liabilities and income increases on your credit side and it reduces on the debit side. So now you will know today that we are focusing on closing off procedures. So we're closing off all nominal account. We said nominal account, we are referring to our temporal account. Those temporal account, we are talking about income and expenses. So generally, you will know that expenses increases on the debit and they reduce on the credit. So when you have recognized the expense on the day the transaction took place, you'll have increased those expenses. But now when you are asked to do a closing off that particular expense, so which means you need to zero out that expense. How do you zero out that expense? If it has already a debit balance here, you need to credit that expense and you're going to debit your profit or loss account, as we have indicated previously. The same goes for your income. Income increases on the credit side, so it means it will have a credit the amount will be sitting on the credit side, and then to zero out that amount, what you need to do, you need to debit that income, and then you're gonna credit what? Your profit or loss. So closing off procedures, we are saying zero out the income and expenses account, but we've already highlighted on the previous slide the order that we do it. So I don't think it should be difficult for us to do the closing of journal entries. As long as you master what I've just explained to you now, we are trying to zero out those income and expenses account. So which means if it's an income, to zero out the income, we need to debit that income and credit your profit or loss account. To zero out an expense account, what do we need to do? We need to credit that expense and debit your profit or loss account. Simple as that. Then on this slide, we are just saying that transactions that affect your expenses and income, they directly affect your equity. If expenses are increasing, your equity is decreasing on the debit side. If your expenses are decreasing on the credit side, you go onto your equity on the credit side, it means your equity is increasing. If your expenses are going down, your equity is going up. When your income go down, you go to the debit side of equity, it's also decreasing. If income is going down, it means your equity is also going down. But if income is increasing, it means also your equity is increasing. It's very, I will keep on stressing that for you to understand the basic accounting equation, because once you miss it from here, it's so difficult to understand everything else that you keep on doing in accounting. It's very important. Spend a lot of time practicing your basic accounting equation. And these things will never change. For example, they will always be like this. Asset and expenses will always increase on the debit, reduce on the credit. Equity, liability, and income will always increase on the credit, reduce on the debit side. So under perpetual inventory system here on this slide, I just wanted to show you, remember that we've already explained that when we purchase inventory under perpetual inventory system, we record that inventory directly into the inventory account. And then at the time we are selling that inventory, the cost price of goods that are being sold, we transfer it from the inventory account to what? To your cost of sales. So here is the summary of a transaction. Then we're just going to look at them quickly, but we're still going to do an example. Here they're saying the accounting entries under such a system can be summarized as follows. VAT is ignored in these examples. So we are dealing with now perpetual or continuous inventory system. When you purchase inventory for cash, what is it that you're going to debit? You debit inventory. The reason is that inventory is coming in and inventory is an asset. Asset increases on the debit side. What are you going to credit? You've used cash. So your bank is decreasing. We know that bank is an asset. It decreases on which side? On the credit side. So this is the journal entry that will have debited and what you have credited. Remember, when you purchase inventory for cash, you record it in your cash payment journal. It is also important to keep on revisiting your subsidiary journals or the books of first entry. But here I just want to show you when you understand what to debit and what to credit. Number two, if you purchase inventory on credit, so it means you did not pay for it, but you bought it. So what you're going to do, you're going to debit that inventory. Again, remember, what we are still trying to prove here under perpetual inventory system is that when you purchase inventory, you record that inventory directly into the inventory account at a cost price. So that's why we are debiting the inventory. And what are we going to credit? If we purchase inventory on credit, we're going to credit that creditor and with what? With our trade payable control. Remember, trade payable control, it's what? It's a liability, and we know liabilities increases on the credit side. That's what we are crediting, trade payables control, because we did not pay for it. We are still owing. So this is recorded where? Under your purchases journal at a cost price. Number two, when we sell then the merchandise, we're talking about our inventory. If we sell it for cash, we are selling the inventory for cash now. I just want to show you. Okay, I'll show you here. We're sale of inventory for cash. Two transactions that need to happen here. Because we are using perpetual inventory system, we need to account for the sale at a selling price. We also need to update. We also need to transfer our inventory to where? To the cost of sales, because now we have sold it, is no longer there. So the first transaction, we sold the inventory for cash. We received the money, so you're going to debit what? The bank. Then what are you going to credit? Bank is an asset. So asset increases on which side? On the debit side. That's why we are debiting the bank, because money came in. So we have more money now as a business. What are we crediting then? We are crediting sales. Sales is an income account. So it increases on which side? On the credit side. But remember here, what is important when we are doing this first transaction, you are recording the amount at what? At a selling price. Then the second transaction that we need to do here, I think when I was doing this slide, it cut here. But here, what you're going to do now is that we need to transfer the cost price of the goods that have been sold from inventory account to what? The cost of sales. Remember that we have sold this good. these goods now. So which means our inventory, which is an asset, it needs to decrease, and it will decrease on which side? On the credit side. So you're going to credit the inventory at a cost price, not as a selling price, at a cost price. And then what are you going to debit? You're going to debit what? Your cost of sale, your cost of an expense, it increases on which side? On the debit side. Expenses increases on the debit side. So at a cost price. So those are, it's very important to understand that when you are making a sale and you are using a perpetual inventory system, two journals need to be processed. The first one, recognizing the sale income. Number two, the one where we are transferring the inventory. We are transferring from inventory account to the cost of sales account. This example, we're selling this inventory for cash, but let's say we sold inventory on credit. So it means we sold it to some debtor, but they haven't paid us. We know debtors are the asset for the business. And then so it means when we sold to them, we're expecting more money to be received from them. So which means our assets are increasing on which side? Asset only increase on the debit side. That's why we're going to debit our data, and we're also going to debit what? Your trade receivables control. Trade receivable control, it is an asset, it increases on the debit side. And then what are you going to credit? You're going to credit what? Your sales. Sales and income. Income increases on which side? On the credit side. Remember here you are recording that at what? At a selling price. Then the second part, we need to update the goods have been sold now. This inventory has been sold, it's no longer with us. So which means it has left the business. So we need to credit what? Our inventory at a cost price. And then what are you going to debit? You're going to debit what? The cost of sales, because now we're saying we're transferring the cost of goods that have been sold from the inventory account to cost of sales. Then sometimes it happens that the merchandise or the inventory is returned by a debtor. So what do we do in this situation? We debit your sales return. And what do you credit? You credit your trade receivables control. Because when they return back the goods that we have sold to them on credit, they are reducing whatever they owe us. Remember here when we said sold merchandise on credit, we debited the trade receivable control, but now they are returning those goods that we sold to them. So which means we need to reduce up their account. We need to credit your trade receivable control, which is an asset. Asset decreases on the credit side. So when they return those goods, what will also happen here? Remember that they sold those goods to, we gave those goods to who? To our debtor, but now those people are returning back those goods. So which means the goods are coming inside now. So we need to have an increase in those inventories. So which means we also need to reduce our what? Our cost of sales. I think there's some error that happened here in the writing, but we will update it. But just have that understanding, they are bringing back the goods now. When goods are coming back, so we need to acknowledge that the inventory that we thought it went out, it has been returned now. So which means that inventory need to go up, and then our cost of sales need to go down. That's why I said there is an error here, because it says credit cost of sale. Oh, it's correct. It's saying credit the cost of sale, because cost of sales will reduce on the credit side. Remember, expenses reduces on the credit side, and then we're going to debit what? Our inventory. So this is also correct. It's just that I would have preferred it to write it first, debit our inventory to show that our asset is increasing, and then we credit what? Our cost of sales, which shows that cost of sales are reducing. So this is also correct, guys. Here, I won't spend a lot of time here. It's the same principle that we apply here when the goods are being returned. But in this situation, they are telling you that if merchandise is returned previously, it was sold for cash. Remember here, when we said here, when merchandise is returned by a debtor, so which means it was sold on credit. That's why we process these journals. But now in the situation where we have previously we sold that merchandise for what? For cash. If the business has a policy of not repaying cash, a credit note will be issued to the client, for that exchange merchandise. But if the business is willing to refund for cash, this is what they're going to do. They're going to debit the sales return and credit what? And credit your bank. Remember, bank is an asset. Asset decreases on the credit side. So if we issue out money, our bank is going down. So number two, to reinstate the merchandise as part of inventory, what are we going to do then? Because it has came back, we debit the inventory and we credit our cost of sales, which means our cost of sales are reducing on which side? On the credit side at a cost price. It's very important to remember. This only happens under what? Under the perpetual inventory system. Lastly, when merchandise is returned to a credit, so now it is a business that we are returning back this inventory to who? To the supplier that we bought this inventory from. So we are sending back that inventory. So when we are sending back that inventory, we are reducing the inventory for the business. We know that inventory is an asset for the business. So what you're going to do then here, to reduce the inventory, you need to credit the inventory, because it's an asset decreases on the credit side. But what are you going to debit then? You need to debit your liabilities. Your liabilities need to go down because you bought this thing on credit and then now you've returned it. So they need to reduce whatever you owe them. So you're going to debit your trade payable control. Your trade payable control is a liability, and liabilities decreases on the debit side. This will have been recorded where? In your purchases return journal. But you're going to understand more this transaction. The more you practice, the better. Let's go to this simple short example. We're illustrating what here? Perpetual inventory system. So you are given here that the inventory on 1 January 20.1. So the opening inventory that we have here is how much? It's 10,000 Rand. The transaction for the year up to 31st December 20.1, they are as follows. We have purchased, they are credit purchases. So we have bought inventory on credit. We also had cash purchases of 40,000. We bought inventory for cash. We also made credit sales. We have sold the inventory to our debtors. That's a credit sale to our clients on credit. For how much? For 75,000. We've also made what? A cash sale of how much? Of 25,000 Rands. But here, what is important here in this bracket is that the markup on cost price is 25%. So they are telling you that we have sold credit sales, it's 75,000 Rand, but for you to determine the cost price, what you will then need to do is that 75,000, it's reflecting what? It's equivalent to 125%. Because remember, for you to get a selling price, you say cost price plus the markup, then you get your selling price. Already they told you here that the markup was on cost price. So which means the cost price will be represented as 100%, then the markup will be 25. When you combine the two, you get the selling price, which is 125%. So which means this 75,000 and this 25,000, they are representing 125%. Then for you to get the cost price, because it's necessary when we are dealing with the perpetual inventory system, is that at the point of sale, what we also need to do, we also need to transfer the cost price of the goods that have been sold to where? From the inventory account to the cost of sales account. So which means to determine the cost price here, what we're going to do, you're going to say that 75,000 multiplied by 100 divided by 125. Then you're going to get your cost price. There is another method also. We'll guide you which method to follow. The markup can also be based on a selling price. If you go to your study guide, it will show you how we calculate for that one. So I'll advise you to be familiar with both methods so that you don't get confused when we ask you questions. So so we know the credit purchases, cash purchases, credit sales, and your cash sales together with your opening inventory that was given to us. So the first thing that we need to do then here is that the credit purchases, let's say, for example, these credit purchases, they happen in that particular day. You were requested maybe to Prepare a journal entry for this. What is it that you're going to debit and what is it that you're going to credit? Remember that we're using perpetual inventory system. If you bought inventory on credit, so which means inventory came inside the business. So we need to debit the inventory of how much? Of 50,000, because inventory is an asset increase on which side? On the debit side. Then what are you going to credit? We've already spoken about this journal. You're going to credit your trade payable control. Why? Because trade payable control is a liability. You are owing that money. You haven't paid for that. It's a liability, and liability is increased on which side? On the credit side. And then you will write a narration here that credit purchases of inventory on the day the transaction took place. This is how you will have recorded that. Because we said under perpetual inventory system, it need to be recorded. The purchase of inventory need to be recorded directly into the inventory account. That's what we just did here. Number two, they told you that the cash purchases amounted to 40,000. We still bought inventory, so which means inventory is increasing. On which side? On the debit side, because it is an asset. Then what are you going to credit? You're going to credit your bank, because bank is cash is leaving the business. So which means our bank is reducing. Bank is an asset. Asset reduces on which side? On the credit side. That's why you say here debit inventory, credit bank 40,000. Then you write here, it's a cash purchase of inventory on the day it took place. Then let's go and deal now with credit sales. We said under perpetual inventory system, two journals need to be written when we make a sale. The first one is to recognize the sale, and the second one is to transfer the inventory to the cost of sales account. So which means we'll need to determine the cost of sales, because we already have the selling price here. How much was it sold for? 75. But what is our cost price? The same will happen for your cash sales. So just remember these two. Credit sales, it was sold for 75,000. Cash sales, 25,000. So the journal entry that we're going to write first for credit sale, you're going to debit what? Your trade receivable control. Why is that? Because when you sell on credit to your debtors, that's an asset for you, and asset increases on what side? On which side? On the debit side. So they owe you more money. That's why we are debiting the trade receivable control account of how much? Of 75,000. And what are we going to credit? You've made a sale. Sale, it's an income account. It's increased on which side? On the credit side. You write that 75,000 rand. Because we said at the time of sale, we need to recognize two transactions, the selling one and the cost of sale one. The second transaction that you need to write here. What are we going to do now? We are transferring the cost of goods that have been sold to where? To your cost of sales. So if we are reducing that inventory now, because it has left the business, inventory need to be credited. Asset decreases on the credit side. We're crediting by how much? By 60,000. What are we debiting then? Because we are transferring the cost of goods sold from inventory account to what? Cost of sales. We need to debit the cost of sales. So you're going to debit here your cost of sales. Cost of sales in expense account, they increase on the debit side. It's 60,000. Someone will ask, how did we arrive at this 60,000? You were told that the markup was 25% on cost price, and inventory was sold for 75,000. To get then the cost price, you will just say 75,000 times 100 divided by 125, then you get your 60,000 rand. There was also a cash sale of 25,000. The markup on cost price is 25%. How do we record that? Because the inventory was sold, we've made a sale for cash, so which means we've received more money now. So our bank has increased, because bank is an asset. It can asset only increase on which side? On the debit side. We debit the bank by how much? 25,000. What do we credit? We've made a sale. Sale is an income account. It increases on the credit side. That's why you're going to post that 25,000. Then the narration we wrote here is that cash sale of inventory on the day the transaction took place at a selling, we recorded it at a selling price. The second journal entry that we need to do for this transaction is that we need to account for the cost of sales, because the inventory that we have sold it now, it needs to be reduced from the inventory account. So we're going to credit our inventory. Our inventory is an asset. It decreases on the credit side by how much? By 20,000. What are you going to debit then? Your cost of sales, which is an expense account of 20,000. So how did we calculate the cost price? We said 25,000 multiplied by 100 divide by 1,125, and then you get 20,000. If you were required to post these transactions now to your inventory account, the first one, okay, let me just go back a bit. Here on this information, you were told that the opening inventory was 10,000 on 1 January 20.1. So because we know inventory is an asset account, that balance brought down will be on the debit side. Because assets increase on the debit side, you're going to put that 10,000 on the debit side. That's what you're going to open with. Number 2, we go to our journal entries that we have written here. We're just going to, the first one, we said debit inventory by how much? 50,000. And on the second one, we also said debit inventory by 40,000. So we need to go to the debit side of the inventory account and post that 50,000 and also post that 40,000. When you post there, just want to show you that inventory on the debit side, we have that 10,000, which is our opening. Then number 2, we have that 50,000 on the debit side. Then we also have that 40,000 on the debit side. Remember that when we debited inventory, what did we credit for that 50,000? We credited our trade payable control. That's the description you're going to write here. When we debited the inventory by 40,000, what did we credit? We credited bank. So that's why we are posting that 40,000 on the debit side. Let's look for other transactions that talk about inventory. So we've addressed these ones. Then let's go back now to these ones. So this first one, it does not talk about inventory, but here the second part of it talks about inventory. It says inventory is credited by how much? By 60,000. What is it that we debited? We debited cost of sales. So let's go to the inventory account. On the credit side, we go and post that 60,000. When we credited the inventory account, what did we debit? We debited cost of sales. Let's go and look for the second journal entry that talks about inventory. This one, the first one does not. The second one we said credit inventory by how much? By 20,000. And then we debited what? Cost of sale. Let's go to the inventory account. We credit 20,000. And then when we credited inventory by 20,000, what did we debit? We debited cost of sales. So we have no other journal entry that affect inventory. And remember, inventory is an asset account. We need to close it off now. So we can already assess which side is bigger than the other one. So there's the bigger side. So we know that your debit and credit, they need to be equal, but we take the amount of a higher side. So here you can tell that it's 10,000 plus 50 plus 40, it makes up 100. But when you add 60 and 20, that is 80. So which means the debit side is more. So we need to have 100 both sides. Then you will notice that the difference between 80 and the 100 is that 20. And then we call that it's a balance carried down. So that balance carried down become the opening balance on the debit side of inventory of 20,000. What does this 20,000 mean? It means we had an inventory of 100,000, we sold 80, we are left with 20. That's why we're having a balance brought down of 20,000 on this debit side. Let me then move to, we've already addressed these ones. Okay, now I wanted us to do now, if you are required to do the sales account. Remember, the sales, it's an income account. And then we're trying to do what? The closing of procedures today. So what we need to do here, let me just go back a bit. I want any transaction that has to deal with sales. Well, remember that when we made a credit sale, we said debit trade receivables, we credited sales income. So sales income is credited by 75,000. So we need to, this is the only transaction that talks about sale. The one below does not talk about cost of sales. So let's go to the sales account. So sales has been credited by what? By that 75,000. When we credited sales, what did we debit? We debited trade receivable control because we made a credit sale. Then let's go back. Is there any other transaction that affect credit, that affect sales? Here, yes. You see here, when we make a credit sale, we debited the bank, then we credited what? We credited sales. So we go to the credit side of the of the sales account, you post that 25,000. When we credited sales by 25,000, what did we debit? We debited bank. That's why we write bank there. Let's go back. Is there any other transaction that affect the, so we've taken this 25, then let's go to the next one. Then before I touch on this one now, we are doing what? So you can already see here that on the sales account, the credit side is more than the debit side, and the credit side amounts to 100,000. So both sides must be equal to 100,000. So which means that we need to close off this sales account. We are zeroing it out. We don't want it to have any balance carried down, because we said earlier the income and expenses account are zeroed out so that they don't have any balance carried down. There's no balance that is carried down. So we need to have what? 100,000 on this debit side. And then I want to show you how we do that. Remember that this is the closing of journal entry that you will be asked to perform. So here, to close off a sales account, then income account, so it increases on the credit, it reduces on the debit. So that to close it off, to zero it out, so it means you need to debit the sales income account, because we know that income reduces on the debit side. But we know that the sales income account, we had that 75,000 plus 25, so which means we need to debit that entire 100,000. And what are we going to credit then? We're going to credit our trading account. This is how we perform a closing off transfer of the sales account to the trading account. So when we say close off that income and expense account, we're saying zero them out. So here, to zero out the income account, we need to debit the income account, because income decreases on the debit side. And then we credit what? Your trading account. That's why you will see here on the debit side it's 100,000, but we don't write, we say when sales were debited by 100,000, we credited what? Trading account. So we don't have to write any balance carried down here, because this account is sitting at zero now. There's nothing that has been transferred to the next month or to the following financial year. So because we have performed our closing off transfer, this is how you perform your closing transfer of sales. Number 2. Okay, the cost of sales now. Cost of sales is an expense account. It also needs to be closed off. Remember on these journals that we did here, we said on the first one, we said debit cost of sale expense by how much? By 60,000. And on the second one, we also said debit cost of sales, which is an expense by 20,000. So which means when you go to the cost of sales account, you go to the debit side, you post that 60,000, you also post that 20,000. So when you debited the cost of sales, what did you credit? You credited inventory. Already you can see that the debit side is more than the credit side. If you add 60 plus 20, you get 80,000. And then, so both sides must be equal. So both sides must be equal to 80. And we know that cost of sales and expense accounts cannot have a balance carried down. It needs to be closed off. So we need to zero out this account. Where do we transfer this? To a trading account. But this is a journal entry that you will have performed here to do that. Cost of sales and expense account, it increases on the debit side, it reduces on the credit. So for you, if you want to reduce that cost of sales account, you need to credit the cost of sale account of how much? By 80,000. And what are you going to debit? Trading account, because that's where you are transferring it to. You're transferring it to the trading account. That's why you will see here that cost of sales is credited by 80,000. And what did we debit? It's the trading account. Now the cost of sale does not have any balances that are being carried down. So on our steps earlier, we said the first step is to say net sales and we said net sales and cost of sales need to be closed off to your trading account. Step number 2, we said, then the trading account, it is a temporary account. It also needs to be closed off to your profit or loss account. In simple terms, you can see here that our sales income was 100, our cost of sales was 80. So which means we've made a gross profit. in these transactions of how much? Of 20,000. So that gross profit, how did we determine it? We determine it in the trading account. So we need to close off that trading account. So let's go back again. Let me start with trading account. I want to show you here. Let's go back here. We said here in this transaction, we said sales income is debited by 100,000. We credited the trading account. So trading account is credited by 100,000 because of sales. Then trading account is also debited here by what? By cost of sales of 80,000. You go to the credit side of a trading account, you credit that 100,000. When you credited trading account, what did you debit? You debited sales. And then trading account, we said it was also the trading account was also debited by how much? By 80,000. And what did we credit? We credited cost of sales. If you compare these two, that you've made 100, but this is the cost that you have incurred, it's 80. So the difference is 20. That 20 goes to where? Because trading account is also a temporal account, it can't have a balance carried down. So which means it's closed off to where? To your profit or loss account. So we've made a gross profit here of how much? Of 20,000. You can see here that trading account is debited by 20,000, and then your profit or loss account is credited by 20,000. That's why you will have this transaction here where we said debit the trading account by 20,000 and credit your profit or loss by 20,000. So here we're saying closing transfer of gross profit to profit or loss account. So that's how you will have dealt with the perpetual inventory system. That's the first part. So now let's look at a periodic inventory system. So periodic inventory system, when you purchase inventory is not recorded. That is not recorded in the inventory account, but instead, what do we use? We record it in a purchases account. Purchases account is an expense account. So which means purchases account increases on which side? On the debit, reduces on the credit. Again, if the inventory is returned to the seller, the return of inventory cannot be recorded in the inventory account, but we record it where? In your purchases return account. So there's a separate account for that, where we record all the purchases returns. So, and the most important thing here between perpetual and periodic inventory system, under perpetual, you see that at the time of sale, we can determine the cost of sale. But here, under periodic inventory system, the cost of sales is not determined at the time of recording the sale. Under perpetual, when we make a sale, we recorded two transactions. The first one was for a sale and the second one was for cost of sale. But here, they are telling you that under periodic inventory system, the cost of sales is not determined at the time of recording the sale. What does that mean? It means you're going to record the sale part. We're not going to talk about the cost of sales. You will see when you do the example. They are telling you here that the cost of sales can thus only be determined at the end of the financial period after doing a physical inventory count. So it's very important to know the differences here. So even when we give you a trial balance, then you see there is on a trial balance, there is a cost of sales. There's a line item says cost of sales. You already know that which inventory system they are using in that entity. They are using perpetual inventory system. But under periodic inventory system, if you look at the trial balance, what are you going to see? You're going to see purchases account, purchases returns account. So they are telling you that they are using what? Periodic inventory system. We don't even have to explain that to you. The moment you look at the trial balance, you see purchases or purchases returned, already you know that it's periodic inventory system. If you see cost of sales, it's because they are using perpetual inventory system. That is a big difference between these two systems. So then under periodic inventory system, then how do we determine the cost of sales? Remember, you were told on this previous slide that the cost of sale can only be determined after we have done the physical inventory count at year end. So for us to determine then the cost of sales, we will need what? The opening balance at a cost price. What inventory did we open with? We add the inventory that we have purchased, the purchases that we have made during the year. We also add your carriage on purchases. the cost of bringing the inventory to your factory or to their stores that they will have incurred. Those are your carriage on purchases that they will need to add to, which will form part of your purchases. And then we need to deduct what here? We need to go less the closing inventory. So for example, what we are trying to, if we try to simplify this, we are saying we're trying to determine the cost of goods that have been sold. So if we've opened with this inventory, and we also bought this inventory, these were the costs that we have incurred for carriage on purchases, and then we are left with this inventory. Whatever the assumption is that whatever is missing, it means it has been sold. That is the cost of sale. That's how you determine cost of sale under periodic inventory system. But let's look at how do we record transaction here, because we were told that under periodic inventory system, when we purchase inventory, we don't record it directly to the inventory account, but we record it where? Under purchases account. Purchases account is an expense account. So let's say here you purchase of inventory for cash. What are you going to debit? You're going to debit your purchases. It's an expense account. Expenses increase on which side? On the debit side. What are you going to credit? You're going to credit your bank. Your bank is an asset. It's reducing on the credit side because you have used cash to buy that inventory. If you purchase inventory on credit, what you're also going to do, you're going to debit the purchases, which is an expense. Expenses increase on the debit side. And what are you going to credit? Your trade payable control. Trade payable control is a liability. Liabilities increases on which side? On the credit side. You are recording all this at what? At the cost price. If you sell merchandise then for cash, you sell the inventory for cash. So you're going to debit your bank. Your bank is an asset. Asset increases on the debit side. What are you going to credit? You're going to credit your sales income. Income increases on the credit side. Remember, you are recording this at what? At a selling price. On this transaction, you see now we don't have to write the second transaction that talk about cost of sale, because there is no cost of sales that is determined at the time of selling inventory under a periodic inventory system. So we'll only have this one transaction. If you sell that inventory on credit, you know that we have to debit our trade receivable control account because it is an asset. Asset increases on the debit side. And then what are we going to credit? We credit our sales income. We know income increases on the credit side. So, and then when the merchandise is returned by a debtor, what are we going to do? We know now already that when we sold it on credit, we debited the trade receivable control. But when they return that inventory, so which means we need to reduce whatever they are owing us. And then assets reduces on which side? On the credit side. That's why you're going to credit your trade receivable controls. And what are you going to debit? The sales returns, that what they brought back. Then they are also explaining here, if the merchandise returned previously was sold for cash, the entry for a cash refund will be as follows. If the business is willing to give that customer or that debtor a cash refund, they're going to just debit the sales return and credit the bank, because bank is an asset, it reduces on the credit side. But when the business now, when we return the inventory to a creditor, what are we going to do? We need to reduce our liability. So which means we need to debit our trade payables control, which is a liability, and liability that reduces on the debit side. What are we going to credit? We're going to credit what? The purchases returns at a cost price. Then at the end of the year, we'll need to do what? To do a physical inventory count, so that we need to know now. Because remember that we cannot determine the cost of sales under periodic inventory system if we don't know what our physical inventory, the closing inventory that we have at the end of the year. So they will conduct what? The physical inventory count at the end of the year. And then whatever inventory that is left there, we need to debit that inventory, because that's a closing inventory that we have. It's an asset increase on the debit side. And then what are you going to credit? You're going to credit your trading account. This is where we're going to try and determine our gross profit. Let's quickly move to this example. I see that I'm pressed for time, and I will, at 6 o'clock, I will try to reconnect because I have a load shedding. So I'll try to reconnect through my phone, and I hope it will work perfectly. Yes, no, I was just trying to make sure that the phone is closer to me. Let's look into this exercise now. Now we are using what? Periodic inventory system. The opening inventory that we had was 10,000. And the transaction for the year, credit purchases were 50, cash purchases were 40, credit sales were 75, and cash sales were 25. And they tell you here under additional information, the closing inventory on 31st December 20.1 is determined as amounting to 20,000 rand. So we are still, this information, the above information is still the same as our previous example that we made under perpetual inventory system. So now, but I want you to pay attention to the journal entries that we're gonna write under periodic. So credit purchase of inventory of 50,000. Under periodic, remember that we cannot record the purchase of inventory directly to the inventory account, but we record it where? To your purchases account, which is an expense account. So what you're going to do here, when you buy that inventory, we need to debit our purchases expense, which is increasing on which side? On the debit side. You debit the purchases expense by how much? By 50,000. What are you going to credit? You credit your trade payable control. It's a liability. Remember that we bought it on credit. We haven't paid for it. So our liabilities need to go up by how much? By 50,000. Number two, cash purchases. We bought it for 40,000. Because we are using periodic inventory system, the purchase of inventory cannot be recorded directly to inventory, but we record it where? To your purchases account. So we're going to debit our purchases expenses, which are increasing on the debit side by 40,000. And what are we going to credit? Our bank. Remember that the money is leaving the entity by how much? By 40,000. So which means assets are reducing on the credit side by 40,000. Then we also, under periodic inventory, we also made a credit sales of how much? Of 75,000. So let's record that sale. We've made a sale on credit. So which means we need to debit our debtors, our trade receivable control, because it's an asset. Asset increases on the debit side. We write that 75,000. What are we going to credit? We're going to credit our sales income. So our sales income will be how much? Will be 75,000 rand. So remember that we are recording the sale transaction at a selling price. What I want you to pay attention here is that we don't for this transaction, we don't write anything about cost of sales, because we cannot determine the cost of sale at the time of making this sale. That's why we don't have anything that talk about cost of sales here. Number two, what they also did, they made a cash sale of 25,000. So what they're gonna do here, okay, let me move. They made a cash sale of how much? Of 25,000. So they've received cash, you debit your bank. Your bank is an asset, increase on the debit side by how much? By 25,000. And what do you credit? You credit your sales. It's an income increase on the credit side by 25,000. Again, here, you don't see anything about cost of sales. So I think now it's clear the big difference between the perpetual inventory system and your periodic inventory system. Then we need to do what now? The closing of journal entries under the periodic inventory system. Remember, we said we are closing off those transactions of income and expenses. So we know that our sale need to be closed off. Then it's 75 plus that 25. So you see, they were credited initially. To close them off, then we need to debit the sales income. Sorry. We need to debit the sales income. How are we going to do that? We're going to debit the sales income by 100,000. And what are you crediting? You are crediting your trading account. Let me just reconnect quickly before I lose connection. Just a second. I hope that's perfect. You can still hear me. Okay, so now we debited the sales income. We credited what? The trading account, because remember, sales need to be closed off to your trading account. Number two, what we need then to do, so the sale part has been done. then we need to close off the purchases expenses to where? To our trading account. So initially we debited the purchases expenses. So to zero out the purchases expenses, we need to credit the purchases expenses of how much? Of 90,000, because it was 50 plus 40. So what we do then, we credit the purchases expenses of 90,000, and what are we going to debit? We then debit what? Our trading account, because that's where we are closing off to. What also becomes important here under periodic inventory system. So we need then to take what? Remember that the formula that I show you, how do we calculate the cost of sales under periodic inventory system? We say opening inventory plus purchases plus your carriage on purchases less the closing inventory. So here, what we do then, we need then to transfer that opening inventory of 10,000. Remember that inventory is an asset. So that if we transfer it to trading account, it means we need to reduce that inventory. How do we reduce an asset then? By crediting it. Then you have to credit that 10,000. And then what are you going to debit? Where are we transferring it to? We're transferring it to the trading account. The purpose we are doing that so that we can determine our gross profit or loss, and also need to know what is our cost of sale. So then that's the general entry that we'll do. So opening inventory, you need to transfer it to a trading account. How do we do that? Inventory is an asset. If you want to transfer it, asset decrease on which side? On the credit side, you credit that 10,000 and then you debit your trading account. Number 2, we are told that under additional information that there is the closing inventory was how much? Was 20,000. Let's go back to that. We're told here it was 20,000. And then here you were told that physical inventory count at year end. Once we have determined that, what do we need to do? We need to debit that inventory to recognize that this is the inventory that we're left with, which is an asset. Then what are you crediting? Your trading inventory. That's what we just did here. We debited the closing inventory, which means our assets are increasing by 20,000. This is the inventory that we are left with. Then we are crediting what? Your trading account. So we are recording the closing inventory in the books. That's what we are left with. These general entries I've just listed here, they are 1, 2, 3, 4. Someone else, once you are advanced in terms of knowing how it should be done, you could have also done it in this simple way, just one transaction, and it will give you the same result. So I want you just to give yourself time and go to your learning unit 7. You will see they will demonstrate both methods. It's either you will have done it this way or done it this way. It's still the same. It will give you the same result. So I don't want to spend time on that. So the same transaction, then remember that we said once you close off your trading account, then need to be closed off to your profit or loss account. So which means your trading account will have been debited, and then you credit your profit or loss account of how much? Of 20,000. It is the same as the one that we did for under the perpetual inventory system, where we say the trading account needs to be closed off to your profit or loss account, because that is step number 2 that we spoke about. So if you are required to prepare a general ledger, remember that the opening inventory you were told that it was how much? 10,000, which means the balance brought down was how much? Was 10,000. Then we said, because this was an opening inventory, we needed to close it off to where? To our trading account. We did that journal entry already. Here we said trading account is debited, and then you credit your opening inventory. So our inventory is credited by how much? By 10,000, and then we debited what? Our trading account. So we are done with this part. Purchases. Let me go back on our journal that affect purchases. We said here, let me just go back. I hope it's not that destructive. The first journal that we wrote, we said debit purchases was 50,000. We debited another purchases by 40,000. So let's go to the debit side of the purchases account. purchases account, we debited 50,000, we debited 40,000. The 50,000, it was a credit purchase. That's why when you debited it, we credited your trade payables control. Then we also had a cash purchases of 40,000. That's why we credited the bank. So you can see already that the debit side is 90,000 and the credit side, there's nothing actually. So we need to make both sides to be equal. So it needs to equal to the highest number, which is 90,000, and we also need 90,000 here. Because purchases account is an expense account, what does it mean? It needs to be closed off where? To your trading account. That's why we have this 90,000 trading account. We've already done this journal entry here. We said your purchases are credited by 90. We debited your trading account. Yes, that's why you credited your purchases by 90, and then you debited your trading account. If you're required to do the sales account, it's still the same as the one that we did for under perpetual inventory system, because initially we said we've made a sale of 75,000, which was credit sales. We also made a sale, a cash sale of how much? Of 25,000. So to close off an income account, which means the income account needs to be debited. It's going to be debited by what? By what was credited. When we debited sales income, what is it that we credited? We credited our trading account. This journal entry is also here. We've done it. We said debit sales, credit trading account. So when you go to the sales account is debited by 100 because we have credited the trading account. So both sides now are equal. There is no balance brought down because income and expenses should not have the balance brought down or carried down because they are zeroed out. That's why we do the closing off journal entries. Then on the trading account already, so this is our trading account. I'll just show you quick. So remember this on the journal entries that we wrote here of closing. Said trading account is credited by 100,000. When we credited trading account, what did we debit? Sales. So we go to the credit side of the trading account. We post that 100,000. When we credited trading account, we debited what? Sales. Let's go back again and see the second journal entry. Trading account is debited and then we credited what? Purchases account. For how much? For 90,000. So we go to the debit side of the trading account. Trading account is debited by 90,000. Because when we debited trading account, we credited what? The purchases account for 90,000. So it was at 50,000 plus 40,000. Let's also go back to those closing journal entries. So you see that once you've done this journal entries, it becomes so easy. We also said trading account is debited. We credited what? Inventory, opening inventory. So we go to the debit side of the trading account. We post that 10,000 because we said trading account is debited. What do you credit? Opening inventory of how much? Of 10,000. What else did we write here on trading account? Oh, sorry. Go back where I'm trying to go back to our journal entries. The last one here, we said trading account is credited by 20,000. And what did we debit? Closing inventory. Because we are doing trading account, we need to go to the trading account on the credit side. We said here 20. Oh, sorry. We said here 20,000. We write here when we credited the trading account. What did we debit? We debited inventory, the closing inventory. Already now you can see that if you add the credit side amount 100 plus 20, that's 120. If you add 10 plus 90, that is 100. So which means the credit side is more than the debit side. So both sides need to be equal to 120,000. So what we do here, we also need to have 120,000 here. So if you say 120,000 less 100 or 120,000 less 90 less also 10,000, the difference is 20,000, which it close off to where? To your profit or loss account, because we said trading account need also to be closed off. It can't have a balance carried down. So that's why you will have here your profit or loss account of how much of 20,000. We've already done this journal entry here. We said trading account is debited by 20,000 and you credit your profit or loss account of how much of 20,000. Then you will be done with that part. So if we are moving to the next slide, then here we're just also is illustrating where if we the accounts, how they get affected if we use different inventory systems when we incur additional purchase cost. I think we've already spoken about the carriage on purchases. So here they are saying the transaction payment of delivery cost of the inventory that you have purchased. So they delivered you've incurred the delivery cost. If you are using perpetual inventory system, what you're gonna do here, when you incur that delivery cost and then you paid for cash, you're gonna debit what? The inventory. Because the delivery costs are done what? Are capitalized, are added directly. So which means we are saying that this additional cost of purchasing that inventory will be capitalized where? Into directly to the inventory account. Even if you incur the custom and import duties, you will add them to the inventory account if the business is following what? The perpetual inventory system. Then what are you going to credit? The bank, because you've paid for those delivery costs. So which means the bank, it's an asset, it's reducing on which side? On the credit side. But if you haven't paid for those delivery costs, you're going to credit what? Your trade and payables control, because it is a liability, it increases on the credit side. But if you are using a periodic inventory system, the additional cost that you have incurred when you're purchasing that inventory, you will report them separately. You'll say debit your carriage on purchases. That's an expense, which expense it increases on the debit side. And then what are you going to credit? You're going to credit your bank because you've paid for that. But if you haven't paid for those carriage on purchases, you're going to debit the carriage on purchases, and then you credit what? You credit your trade payables control. So here, they're just showing you this information is there in your learning unit 7. Here they are saying use the following information from the books of GOGO dealers to calculate the cost of sales. Already you can tell that they're using what? The periodic inventory system, because you see terms such as your purchases and your carriage on purchases. And they tell you here at the end that a physical inventory count. So it was conducted when on 31st December 20.1 and indicated that the inventory on hand amount to 80,000. So how do you calculate the cost of sales? You will say opening inventory plus your purchases plus your carriage on purchases, then you minus the closing inventory. Because if you've opened with 95,000, you also bought an additional inventory of 260,000, then you incurred that 3,600 carriage on purchases, then you are only left with 80,000. It will give you the cost of the goods that have been sold, which becomes easy. So it's 95,000 plus 260 plus 3.6, you get 358,600. Then you less your inventory of the closing inventory of 80,000, you are left with a cost of sale of 278,600. Also here, they are just showing you it's there in your learning unit. They're talking about drawings and donation of inventory under each, how it's recorded under each inventory system. If you're using a perpetual inventory system, when the owner takes inventory, what do? You debit the inventory. You debit the drawings, and then what do you credit? You credit the inventory. Remember that the owner is taking inventory out of business for personal use. So which means the inventory is reducing. Inventory is an asset. It reduces on which side? On the credit side. That's why we are crediting the inventory and we are debiting what? The drawings. Again, under perpetual inventory system, the donation of inventory. What you're going to do if the business donates inventory. So it means inventory is reducing. We know now we're going to credit inventory. What are we going to debit? We need to debit those donations. But if we use a periodic inventory system and the owner takes the inventory for personal use, what are you going to debit? You debit the drawings, and what do you credit? You credit purchases. Remember that we don't use the inventory term or account under the periodic inventory system. We record it directly to the purchases expenses. Then if there is a donation, the same will go under periodic inventory system. You will credit your purchases and you will debit your donations. Then let me move to here. We are not going to do this example because of time. I just wanted to show you just what we normally give you. Here in this situation, you are given a pre-closing trial balance. What does this mean? It means that adjustments have already been taken into account. The only thing that we are trying to do now here is to do the closing of journal entries. So what need to be closed off here, you will see that earlier I explained that income and expenses will need to be closed off, so they need to be zeroed out, which is clear here. Your sales need to be zeroed out, your sales returns, your purchases return, rental income, stationery, wages, water and electricity, credit losses, settlement discount granted, and settlement discount received. Check, you will see here, even on this folio, on this referencing, these are your N, these are your nominal accounts. Nominal accounts are temporal accounts. At the end of the year, when you want to prepare financials, they need to be zeroed out. I think we've already addressed a number of transactions. I will just pass by quickly here, but what I will encourage you to do, go and see this example and try to understand and try to make sense what we have covered during this session that I had with you today. For example, what I'm trying to show here is that here you were given your settlement discount granted. I explained earlier that before you close off your net sales to your trading account, you need to close off what first? You need to close off your sales return and your settlement discount to where? To your sales income. So which means you need to reduce that sales income by your sales return and your settlement discount granted. So, and we know income reduces on which side? On the debit side. So this is what will happen here. You will debit your sales and you will credit what? Your settlement discount granted. This is our settlement discount granted. It's 150. You see, it appears on the debit side. To close it off to your sales account, you need to credit it and debit what? Your sales by 150. Please go through this example. I'm just trying to pass by to make sure that you don't make the mistake of when you're doing closing off transfers, especially for sales, you end up forgetting to do this. Again, I also explained that you also need to do what? To close off your sales returns to where? To your sales. Your sales. So it means your sales need to be reduced by your sales return. How do we do that? We need to debit the sales and then we credit what? The sales return. When you credit the sales return will be zeroed out. That's what I'm trying to show here. Sales debited by 1.5 and you credit your sales return. Then this is the transaction that we normally do then after removing those two. So where we say now we're closing off our sales. Remember now, check here, the sales that was given here on a pre-closing trial balance, it says 77,500. But here, I'm not quite sure what happened with this figure here because it will have led to a reduction. Okay, then we'll have what? You debit your sales and you credit what? Your trading account. So first thing, close off those two to your sales account, and then what you do after that, you then close off the net sales towards your trading account. I'll just have to confirm these figures here. I'm not sure whether it's correct. Number 2. So we've already addressed this one. Okay. Is it going back? Then number 2 here, what I also want to show you here, before you close off your purchases account, please make sure that you close off your purchases returned and your settlement discount received to where first? To your purchases returned. So that's why in this transaction, you will see that when you are closing off your settlement discount received to your purchases account, which means your purchases account need to be reduced, because purchases account is an expense account. It reduces on which side? On the credit side. So we credit the purchases, we debit the settlement discount received. We're going to do the same with your purchases return. You need to credit your purchases and you debit your purchases return. That's how you close off your purchases return to your purchases account. So you will see that most of the time what we've spent on, we're just dealing with the transferring of, closing off your sales and your cost of sales to the trading account, and also doing what? Transferring your trading account to your profit or loss account. But we haven't dealt with step number 3, where we say all other income and expenses that are not closed off into the trading account, they need to be closed off to where? To your profit or loss account. So here we are talking about which items are those. So because it's clear now, sales return, purchases return, settlement discount granted and settlement discount received have already been closed off when we're doing our trading account. So which one are remaining? We are remaining with rent income, stationery, wages, water and electricity, and credit losses. These one need to be closed off to where? To your profit or loss account. Here, let's start with your closing transfers of expenditure. So which means we are zeroing out all the expenses account. So how do we zero an expense account? So it means the expenses need to be credited, and what are you going to debit? Your profit or loss account. That's why here you're going to credit your stationery, you credit your wages, you credit your water and electricity, you credit your credit losses. But what do you debit? You are debiting your profit or loss account in all these expenses, so that you make sure that these expenses are sitting at zero, have been zeroed out. There are no balance carried down. Then for income, what are we going to do? We need also to close off our income. We saw there that we have rent income. How do we zero out an income account? We need to debit the income account. You're going to debit that rental income, and what are you going to credit? You're going to credit your profit or loss account. Then again, we know that the profit or loss account, it's a temporary account. It needs to be closed off to where? To your capital account. So here they are showing you that what are you going to credit? You're going to credit your capital, and what are you going to debit? Your profit or loss account. So here we are transferring the profit to the capital account. If you have made a loss, so here we've made a profit of 17,750, but if we have made a loss, the closing transfer will have been the opposite. You will have debited the capital and then you credited the profit or loss account. That's why I want to encourage you to go to this exercise and try to work it out. Apply the principles that we just discussed here. Once that is done, so now it means your profit and loss has been closed to capital account. Remember, capital account, it's a permanent account. So it's there to stay for as long as the business exists. So it's just going to be up and down, it's increasing and decreasing due to changes. If they contribute more additional capital or they make more profits, it's going to increase or decrease. If there's more drawings that they're taking out, it's going to reduce. So here, what you also need to do is also to, maybe let me go back a bit here so that we show you why are we, oh God, sorry. Here, before I discuss this journal entry, let me just go back a bit where we were discussing the drawings. I think there was a part where we discussed drawings here. Okay, here we're discussing what? Drawings. So when the owner took the inventory for personal use in both methods, we debited the drawings. We debited the drawings. But now we are saying in that closing transfer, now we need to say we need to close off the drawings account to where? To the capital account. Because remember, when the owners are taking from the business, they are taking from their capital, they're taking from their equity. So their equity needs to reflect a reduction. That's why here you will see now here we are saying we're going to debit the capital and we're going to credit what? The drawings. Drawings need to be credited so that it's zeroed out. It's no longer there. It has been closed off. So that's how you do. This is the end of your closing off procedures. So it's very important. Once you have done the closing off procedures, you will notice that what you are trying to do there, you're trying to eliminate all income and expenses. That's why here, this now I'm showing you the post-closing trial balance. Under a post-closing trial balance, you will never see income and expenses. And you won't even see the drawings because all those things have been closed where? To the capital account. That's how a post-closing trial balance looks like. It means this is a trial balance after considering the closing of journal entries. Please go and practice and then you will see what we are talking about here. So once you have done all the closing of the closing of journal entries, you can see that you can prepare a statement of profit or loss. Under statement of profit and loss, you have your revenues, your calculate your gross profit, then you have the profit for the year. So it's very important to know the structure of the statement of financial position, because sometimes we might ask you during a compulsory assessment, maybe just to show us up to determine the gross profit using in this format. So you will have to apply this format as it is. You don't have to mix things around, because sometimes when you mix things around, for example, here, you can't just say, okay, let me start with net purchases and followed by your opening inventory. No, we did not teach you like that. We said we start with an opening inventory, then we add your purchases and you add your carriage on purchases, then you less your closing inventory. So the structure is also very important. So you have to work out on your own on this example. Then sometimes we'll ask you to do what? A statement of changes in equity. Statement of changes in equity, our column that we're going to have here, it's a capital column. So we start with what? With the balance, the opening balance on the capital, followed by what? By your total comprehensive income for the year. Remember that we have transferred that profit or loss to the capital account. This is the one that we have transferred. It comes here, that's 17,750. Then we said the drawings need to be what? Need to be reduced. Remember that we said debit the capital, credit the drawings account by 3,000. You reduce like that, then you get the balance at 31st January 20.1. Again, when we ask you for a statement of changes in equity, it needs to come in this format. If you mix these things around, remember, since the way our system is designed for our assessment, you will be penalized for that. You need to know the structure. Wait, what comes first? You can't start with a closing balance here, and at the end you have an opening balance. That will not assist you. So that is the end of our session. I hope, yeah, we are just 3 minutes away. So yes, let's stop it here for now. And I will also, I think tomorrow I'll communicate the next class that we're going to conduct for FASET. Probably it's going to take place on Monday. We'll communicate the time so that I hope you're also going to join, so that's going to assist you as you prepare, as you complete your compulsory assessment number 2. Remember, compulsory assessment has been opened today from 21 April, and it's going to close when? On the 3rd of May. Thanks. Let me just close now. Thanks for attending. Dion, you can end the session then.